You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook Radio, the program here on the old network where we break down the sometimes seemingly impenetrable world of options into nice, easily digestible offensive and defensive plays that you can utilize in your own portfolio. Maybe you're worried about some valuation levels. You want to play a little defense. Got you covered. Maybe you want to generate a little bit of extra bang for your buck, a little bit of income on your portfolio. Got you covered there as well. Maybe you want to get speculative and crazy. Got all that and more here on the old Options Playbook Radio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. And if you're saying to yourself, wait a minute, that's not the usual guy on this show, you are right. So let me toss it over to your usual host and the options guy over there at Ally Invest, Mr. Brian Overby. Brian, welcome back to your own show, sir.
All right. Well, thank you, Mark, for that great intro. And I'm always excited when you and I get a chance to talk because one of my favorite things to do is address listener questions. And when you and I get together, that's what we get to go back and do. Because without that feedback that we get from the listeners, the show can't progress. We can't get better. We can't make better traders out of our listeners. So I think it's time to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the Huddle. This is, of course, a portion of the show where you guys get to take the reins and dictate what the heck it is we talk about with your questions, your comments. You know how to hit us up here on the old show. And our first question, Brian, actually is a spillover from another show on the network where it kind of got an interesting debate rolling, and it's kind of jumped from show to show now. And I think it'd be a perfect one to discuss on this program as well. This one comes from Ed Bankert. He's asking, he says he's debating on using covered calls or short puts. He wants to know which is better for a less experienced options trader who wants to make money. Now, this is interesting, and it kind of, people have different opinions on this, which is why I wanted to get your thoughts on this as well. When I first saw this question, my initial thought process was, and we see this a lot on our network, people come to us typically when they're options beginners, and obviously you see this a lot over there at Ally as well. They usually come from the stock world, typically the long stock world. So for those types of people, when you're introducing them to new concepts, something like a covered call seems to intuitively make a lot of sense to those people. Because they know stock, they know working limit orders to sell a stock. So if you explain a covered call in those terms, they tend to be able to wrap their heads around it. Now, you and I obviously both know that synthetically, risk-wise, short put is the same thing. But when you start telling someone who's never really seen an option before, wait a minute, you're going to sell this thing, what that really means is really you want to buy this thing down here. It's a bit of a counterintuitive, logical leap for those people to have to make, and they seem to struggle with that, whereas the covered call is not the thing. Now, on some other shows, people have made interesting counterpoints to that and said, well, actually, I prefer the short put because that gives you a chance to not have your upside capped versus the covered call where you're effectively getting your stock called away. And so you're capping your upside from the outset versus a short put. If you get the stock, you can have the upside and you don't have to worry about some of those things. So there's different arguments I've heard for both sides. Personally, myself, obviously, if I'm going to utilize something, I don't use a lot of covered calls because I don't trade a lot of underlying, so I'm much more of a short put guy. But explanation-wise, going to a pure options beginner, I tend to lean covered call. Brian, you're interacting with the retail folks day in, day out. I'm curious, which side of this debate do you follow?
I am going to join you on the covered call side.
I knew you were a very bright man. I can just tell.
And the biggest thing about it is that most people own stock. And that's where I like to start when I'm talking to retail traders is, okay, you want to learn about options? Yeah, let's learn about options. I can't wait to get rich speculating and leveraging my portfolio. And I always say, hey, wait a minute, options really were intended to be used more as hedging and insurance products. And if you approach it that way, you're going to understand options much better. So instead of buying that out of the money call option, why don't we sell it? And why don't we sell it on a stock you don't mind getting rid of? And if you approach it that way, then the biggest thing about it is they understand the pricing. They'll watch how that option moves over the time. They'll learn how those options decay. They'll figure out, when expiration is approaching, what exercise and assignment means, and those little things that are involved. And I always say, just make sure that when you're doing your first strategy, that you're literally doing it on a stock that you want to sell. And that is, the research that has been done, and I'm just going to paraphrase a quote here, but I used to work at the Chicago Board Option Exchange and very close, used to teach Options Industry Council seminars. And the quote always was that people traded stocks for 5 years before they dipped their foot into the world of option trading. I think that number has changed. That was back in the day, but in theory, I really believe most people will own stocks beforehand. And if you're just talking about the concept of selling a stock that you already own, that you wouldn't mind selling at a higher price, it's a much easier thing for them to grasp than selling a put with the intention of buying stock, right? The biggest thing about puts, and I screw this up all the time too while you're lecturing. It's so hard to say I'm selling a put, so now I got put the stock, so I bought the stock. I sold this put, so I bought stock when I was assigned. And that concept is really hard to grasp. And I very rarely have a retail customer ask me a question about a put and get the entire question correct. So that's what would lean me towards the writing of the covered calls. And then, and it's also a nice little segue to getting rid of the stock at all, period, and as you know, one of my favorite strategies that I coined, the fig leaf, where the next step is, okay, let's not write that covered call on a stock position we own. Let's buy a deep in the money long-term option that acts like stock and start doing that position against it. Now, with all that being said, once you get your feet wet, I think, on the call side, then I really like the strategy of cash secured put selling. One of my, as an instructor, the one strategy that I hear time and time again from people that have traded options and advanced traders, non-advanced traders, beginning traders, people that just kind of do it, is the concept of selling a put to buy a stock, and when they get the stock, sell a call to get rid of the stock. And I mean, that strategy has just persevered for many, many years. Many people that do it usually don't stop. They usually continue to do it and bring in income above and beyond any dividends that stock might pay. And then I guess I was just going to point out, in the Rookies Corner, I have both strategies in the Options Playbook. We have a section called the Rookies Corner, and I think I answered your question just by the way that I ordered them. In the Rookies Corner, I just pulled it up on optionsplaybook.com, and the first strategy that pops up is writing covered calls. And then it does leaps with a stock substitute. And the third strategy, leaps call, the fig leaf strategy. And then the third strategy is cash secured put selling. So I think I answered it when I wrote the options playbook.
There you go. It breaks it all down right there. What's the old saying? You can always tell a genius because he thinks exactly like you. So, Brian, I've always known you were a genius. But yeah, that's kind of how it breaks down for me. I think most of our hosts have leaned that way as well. If you have taken the contrarian opinion, because it's interesting and fun. But yeah, I think it's just from a pure, forget efficacy, forget everything else, just from a pure explanatory basis, the covered call usually resonates with people a lot more, particularly your typical long stock trade. I'm a fan of that trade you mentioned too, the wheel trader. Some people call it the triple income trade. You sell the put, you get the stock, turn around, sell the call, you get in, you get out, you get paid hopefully both ways. It's a lot of fun to be had by mixing and matching these strategies. But from a pure introductory standpoint, I think one is certainly easier to intuit than another. Let's see, we got a couple of related questions here, so we'll tackle these together. First one is from Duffy. He or she wants to know, how do you handle the fixed time aspect of trading options? And then we have a comment here from Charlie T, saying he's not really an options guy. He doesn't need the headache of yet another unknown element, aka time. It's hard enough just picking my stocks, deciding on price points, exit points, etc. We hear this a lot. I'm sure you hear this a lot as well, Brian, because there is that ticking clock aspect of options, which can be intimidating to stock traders. How many stock traders have you talked to, Brian, where they buy a stock and then it moves aggressively against them, and then what does that trade become? Oh, now it's a long-term hold, right? That's something you have the luxury of doing in the stock world that you just don't have in the options world, because that clock is always ticking. One of our hosts on our old shows used to say that options die a little bit every day, and that's true, and that could be intimidating for a lot of people. Of course, obviously, your viewpoint on that depends really on how you're trading. If you're more of a short premium option seller, that ticking clock is kind of your friend. The more it ticks, the more decay you're collecting, the happier you are. If you're an option buyer, that ticking clock has now become your enemy. Every day that ticks, where the underlying hasn't done what you want, or the volatility hasn't done what you want yet, is another day that your options are dying a little bit, eroding a little bit. So that can be scary. That can be intimidating for a newcomer to options. So, Brian, when someone's coming to you, and I'm sure you've had this different variations of this question a million times over the years. They come, they're used to looking at a stock and planning out a time horizon. They buy it, and if it works for them, great. If not, it doesn't work in a certain amount of time they anticipated, guess what? They keep it in their portfolio and they wait till it happens. How do you get people over this hurdle when it's coming to options? They say, I would like to trade them, but I don't know which month to pick, or just the whole notion that it expires just freaks me out, so I don't do it. I'm sure that's a thing you've encountered before. What do you say to people like Duffy and Charlie T and everyone else out there who's just freaked out about the fixed time aspect of options?
All right. Well, you already touched on one thing, is that you can buy them and you can sell them. So you can choose where you want to be as far as time decay is concerned. But what I usually would come back and say, if this is something that you are worried about and it's a big concern for you, think about spreads, and in particular long spreads. Now, my biggest problem from questions like this is I think that almost every one of whenever it comes to me, my first thought is out of the money call options. I'm buying them. I'm buying out of the money call options. How do I manage this time decay? How come I'm right on my forecast and I still lost money on my option trading? And to me, that means you're buying the wrong option. You don't understand option pricing, and you're buying it for the wrong reason. You're buying it because it's cheap. You can buy a lot of them. You can manage your time premium. There's so many different ways that you can trade options and set up a strategy, but we don't have time to go through them all. But I'm just going to tell you one simple little thing that you can do is buy more in the money. If you buy in the money option contracts and you pay more for them, and I'm not talking about the $2, $3 option kind. I'm say you go $4 or $5 in the money on an expensive stock. Now you're buying more real value, which is called intrinsic value in the options world, and you're going to get less time value. So on a percentage basis, that time decay isn't going to be that big of a deal to you. Now, let's take it one step further, and let's say we are buying a little bit more in the money option. I always pay attention to how much intrinsic value I'm buying versus how much intrinsic value that I am selling. So a simple thing is, let's say I'm going to paint a picture, and then I'm getting a little bit on my soapbox right now. I can feel it, but this is the way I talk about a lot of things on our midday market call, because specifically we're doing the midday market call based off of a chartist, Michael Kahn, who's a CMT. He's a chartered market technician, and he's always looking at a stock of the day. So I like to look at, let's say we got a $100 stock. I might buy the 97.50 call and sell the 102.50 call. So we're 5 points wide, but we are just as much in the money on the one that we're buying as we are out of the money on the one that we're selling. So options are simple when you think about time decay. If you just understand this little notion that if I'm 2.5 points in the money on the one that I'm buying, and I go and I sell an option contract that's 2.5 points out of the money, guess what? I should have bought very close to just as much time as I sold. That takes out the time decay factor, period. So if I'm buying as much time as I am selling, and I'm doing this as a debit spread, a long spread, a bull call spread in this situation, well, then I can totally remove that time decay piece and not have to worry about it. So here's probably my most talked about trade on our midday market calls, when we have a short-term forecast where we're looking for, if the move goes, if we break out to the upside, we expect it to go here, but if we're wrong, we expect it to go here. All right, so in that instance, I can actually set my entire time parameters up on my spread, and I'll say, okay, I'm going to go 10 days out. I'm going to buy this option contract. I'm going to sell that option contract. If I'm correct, I'm going to make, it's usually going to be about a 50-50 bet. So if it's 5 points wide, I'm going to pay $250 for it. If I'm correct, I make the $250. If I'm incorrect, I lose the $250, or I put a stop in and I don't let myself lose on the downside. I only make on the upside. There are just so many different ways to manage the time premium with options. When you just go one step next, stop looking at buying out of the money calls and start looking at doing some spreading, maybe just buying deeper in the money option contracts. Like, to me, when I get this question, it means that it's time for you to go to the next level and just start doing a little bit of research on a few more, I'd say, medium trades, not advanced trades, just medium trades, the next step, tying two option contracts together.
There you go. That's these questions start off so simple, and then they evolve into many different ways and shapes, which is why we love when you guys write into us, because really it does kind of make the show, and it keeps us on our toes, which is always fun. Unfortunately, that's all the time we have to huddle up on this episode. Keep those questions coming. We do love to hear from you guys. We read them all. We try to respond to them all directly whenever possible, and if not, we always make sure we route them to some other place where we can make sure your questions get answered. So get them in, send them in, keep them coming. We do love to hear from you guys. And Brian, after listening to all this, maybe they have another question they want to ask you directly, or maybe they want to learn more about what you guys have going on over there in the land of Ally Invest. Where should they go? What should they do?
Well, I'm just going to simply give them my email address. If you do want to be a part of a huddle up or have a chance to be, just send me an email directly at theoptionsguy@invest.ally.com, theoptionsguy@invest.ally.com. I'll answer your question directly if it's a fairly simple one via email. And if you get some great topics just like this, Mark and I will huddle up and we'll answer them on the show. So with that said, I'll say thanks for listening. We'll be back same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.